Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for November 22nd of 2021. Please hear a disclaimer for important information. Well, as we start the chart pack this week, I want to draw your attention to our high frequency data. There's a couple of data points that are probably worth mentioning here. First, in no particular order, the TSA checkpoint data, we've seen that number be consistently about 20% below for several months, and now it's beginning to narrow a little bit. So TSA checkpoint data relative to the pre-pandemic environment of 2019, we're down about 15.5%. So that's a bit of an improvement. We're seeing more activity in airports. Global commercial flights are still down about 21%, but that really speaks more to capacity. And what you're seeing is flights that are more full now. You're not necessarily seeing as much inventory being put back on the market yet because of staffing issues and things like that, but at least the throughput at airports is increasing. The other thing too, open table restaurant, we're seeing that consistently narrow relative to 2019. Hotel occupancy is the same issue. So we're getting a little bit closer to where we want to be in terms of some of these high frequency indicators relative to the pre-pandemic environment. We're not there yet, but we are making lots of good progress here. We talk a little bit about some of the economic data. We have a couple of regional Fed survey results that have been released. This one is the Philly Fed survey. We also have the Kansas City Fed release their survey. We've got two different data series going back to 2007 here. The first of which in the blue is the Philly Fed Business Outlook survey, and this is a diffusion index. And what that means is that everything above zero represents expansion, positive, basically, conducive conditions. And you can see that blue line has taken a decided move up. And this is a consistent type of reading that we've seen in some of these other surveys. Now, obviously we've got pandemic, we've got inflation, we've got supply chain issues, so on and so forth. But this is a measure of business outlook on the part of the survey respondents within this particular Fed district, and it is positive. And to dovetail against that, you see the Business Outlook survey, at least in terms of employees, and this is kind of a broad-based type survey set of questions that kind of gets at the root of, how do you feel about your, employment situation, number of employees, so on and so forth. And that's a bit more muted, I think, for obvious reasons, but the main takeaway from this chart here is that the outlook on the part of survey respondents, not just in the Philly Fed, but I think more broadly speaking, is definitely positive. And here's drilling down a little bit more into some of the Philly Fed data that has been released. And again, there are variations on this when you go and look at the Kansas City Fed data, but just in the spirit of completeness, there are things that aren't necessarily as strong in the KC data as there are here in the Philly Fed data. But we've got four different charts here to show you. First, probably not terribly surprising, the upper left is unfilled orders, but you also have demand really high. So unfilled orders is a reflection of demand, and that has spiked back up. So positive sign there. So delivery times down in the lower left, you can see that it continues to be elevated relative to the historical backdrop. And again, these data series go back to 2005. So it's a pretty profound delta that we're seeing relative to historical trends in both unfilled orders, i.e. demand, delivery times. We know that there's supply chain choke points that are at play here. But then when you slide over to the right side, I think this is really the takeaway, the key takeaway from this. So we've got demand, and we know that input prices are higher. We've got raw material costs, and we've got increased costs of shipping as more producers and interim stage of production manufacturers are having to use air freight, which is really costly. So on and so forth. Prices paid is not only moving higher, but it's staying higher, and that's a big problem if you can't get prices. But if you look at the lower right, this is very consistent across the board. If you look at the other regional surveys, is that prices received is going up at a more than commensurate rate right now. So it does mean that at the retailer you're paying more, at the obviously the gas pump, not as relevant to this data, but retailers at the stores, things that you're buying online, whatnot, those prices that you're paying are higher because prices that are received by the producers is going up to help cover the increase in the prices paid. Now, kind of taking a step back, so we know that costs are moving higher, inflation's moving higher at the retail level. We know consumer balance sheets are very strong right now. Some of that has to do with the move in the equity market, but probably as much, if not more, to do with the increase in real estate prices. But if you back out autos, which we know have been a little kind of quirky lately because of supply chain issues, which have curtailed a lot of new inventory of autos coming on the market, and gas, which can be a bit volatile. But if you back those two things out, U.S. retail sales have been exceptionally strong. And this is actual retail sales data. And you can see relative to trend line, we've really moved higher like a rocket ship in the wake of the pandemic. And a lot of this big move happened in the last quarter of last year. Now we saw, we were still in the throes of kind of another wave before Delta really took hold here in 2021. But that has not stopped retail sales activity really in any way, shape, or form. Consumer sentiment remains very strong. Now, on the right-hand side, we've got the retailer sales survey. So this is how the retailers feel about what's going on in their stores. So even though prices are higher, maybe some merchandise is hard to get, but as you'll see in a few slides, that the major retailers are getting the inventory that they need. But inventories, by and large, are really low outside of that. You can see, despite that, despite the inflationary pressures, that retailer sales surveys are really high right now. All right, so this is pricing power on the retailers. So this is just another look. Now, we saw pricing power as it relates to producers, and so we know producers are getting it. So, and they're passing it along into the channel, and this is kind of this last mile type survey right here. So it's the retailers that are selling essentially to consumers. And the retailers are telling us in this survey that they're getting pricing. They're definitely getting pricing. So you can see the inflationary pressures being pushed throughout the supply chain into the end user, or the end buyer, if you will. And that's actually a bit of an anomaly. We've seen little bouts of inflation at the producer or production level, where the various stages of the chain have absorbed those higher costs due to the competitive nature at the retail level, and those costs haven't been passed along. Well, now what we're seeing is essentially a cost basket or inflation pressures that are just so broad, not just material and equipment and raw materials. We're seeing labor costs move higher, so on and so forth, and that has finally pushed this environment where we're seeing prices being captured at the end user level. Well, a couple more things before we kind of leave this topic. On the left-hand side, and I told you that the major retailers are finding inventory. You can see that on the right-hand side. That's Walmart and Target combined inventories, and this came from FactSet. But you can see here that inventories have actually moved higher in the aggregate for Walmart and Target. So they're getting inventory. Those are big companies that can afford to ship by air or have their own private shipping fleet. Again, with the ports being clogged, and container ships struggling to be offloaded. I mean, we've got a chart on that coming up as well. But I mean, the largest companies that have the financial wherewithal to find workarounds and to circumvent those bottlenecks, they're getting inventory. However, if you look back at the left, this is the in retail at the retailer level inventory to sales. And just think about it, inventory divided by sales. And so that number is really low, and that means that when you get well below Walmart and Target, people are really struggling to find inventory, and that's just a function of the supply chain issues that we're seeing now. We know that sales are moving higher, and not only in terms of unit sales, but also in terms of dollar sales too, because pricing power. But as we head into the holiday season, the chances are really good. And this read through here is that if you go to the big retailers, you're going to find a lot more of what you're looking for than if you're going to the boutiques and things like that, because those folks are having much more trouble finding inventory right now. So as we've talked about the supply chain choke points, and this is a look at the Port of Long Beach, which is one of the top 5 container shipping ports in the world, and Southern California, and you can see the inbound fleet, the inbound cargo and container ships continues to move higher. These are basically large container ships that are literally at anchor waiting to unload. And there's a lot of reasons why, probably beyond the scope of this production here to kind of go into those things, but clearly we're still seeing some increase in clog, if you will. Now outbound, again, this is a function probably as much of the trade imbalance as anything else, because our consumers are in great financial shape. They're buying a lot. They aren't as price sensitive. They just want it. And so, our trade imbalance with regard to consumption is really, really strong right now. And that's why you've got this differential here. Outbound freight, we're not exporting as much. There's not as much relative demand. So the outbound freight is not necessarily as strong, but inbound certainly is. And we'll take a quick look at the Conference Board U.S., essentially the index of leading economic indicators. And this is a month-over-month survey. And again, this is kind of pointing to the same type of atmosphere that we described in our first couple of slides, where we saw business optimism was really strong, and that's reflected in the leading index here. Now, this is a calculation that's based on a lot of things. It has to do with stock market, purchase orders, and orders for durable goods. There's a basket of things that go into calculating this. But as you can see here, and I show this rather to kind of emphasize that with all of the rhetoric out there about inflationary pressures, and all the rhetoric about maybe this more recent kind of uptick in coronavirus cases, that the actual economic backdrop is fairly sound. Now, that's not to say that that the equity markets can't become more volatile in this type of environment, because they certainly can. But just want to point out here that the leading economic index is been positive throughout this year, frankly, and we had a really good reading last month. So I thought I'd show this. This came out of a Schwab research presentation, and we talk about wage pressure, we talk about hourly earnings moving higher, and it really struck me here. This is something calculated by the Atlanta Fed, reported in Bloomberg, was in a Schwab research report, where you see that the highest earning quartile, those wages aren't moving higher. In fact, they're actually decelerating in some respects. Let me rephrase that. They're not negative. They're growing at a slower pace. So less acceleration, and if you want to equate that to deceleration, um, that's where I'm coming from on that. However, if you look at the lowest earning quartile, that's in the blue. Those wages are moving higher. These are the service industries. These are the jobs that have been really, oddly enough, been really tough to fill. And we've got essentially 1.4 jobs for every unemployed person. And a lot of those jobs are in this lowest earning quartile, the service industries, the hourly workers. But we do see the wages are moving higher there. Another employment-related item here, we talk about labor participation, in the same kind of sentence that we talk about quit rates and retirements and things like that. And this is just basically kind of a raw calculation of a couple of things here. It's a civilian employment to population ratio. We know what the population is. You can calculate how many, how many of those in the population are actually working or actually employed, and you can see that's in the blue, and then both of these are very descriptive. In the amber here, you see employment overall population, and it's a broader description. It captures more areas of the labor market, but you can see here in both of these that even though we've picked up a lot in the labor market, as strong as labor has been, relatively speaking, that we're still below the trend line that was established back in the aftermath of the global financial crisis, as you can see in that uptrend in both of these. So we're still lacking. Some of this has to do with the fact that we have had a surge in retirements amongst baby boomers, and so those people have more or less permanently left the workforce, and so that's had an influence on this, as probably as much as anything else has. Well, you've heard me talk about household balance sheets being in really strong shape right now, and we talked about employment wages going up for the lower income cohorts, and here we can see in kind of a breakdown from the Federal Reserve here is essentially excess cash per household by income quintile. So it breaks it into basically 20% sections, and you see that excess cash is really high at the high end. We do see that wages are kind of decelerating at the high end, but that still doesn't really is not making a difference because savings and excess cash on hand is really high. So this is consumption power that exists at the high end cohort here. And as you slip down into those income tiers, that the excess savings naturally goes down, but it's still positive. So again, we're not at a catastrophic place by any means. In fact, we're in a really good position here. And if you look at the 20 to 40 and 0 to 20, these are the levels that you're seeing wage increases at. And so you think that these numbers would probably expand over time. And when this data gets updated, perhaps at the end of this year, you'll see that those lower bands begin to see increased excess cash per household. And what that really means is it provides feedstock for additional consumption as we head into next year. And as long as consumers are confident, then that oftentimes they will put their cash to work. Now, I expect that at the higher income levels that they will continue to save it. Lower income levels, as we clearly saw during the pandemic when the stimulus payments were sent, that the lower income cohorts were the ones that were doing all the spending. And so, what does this mean for 2022? Again, if we, have unexpected inflation, which might get people at the high end to want to commit to consumption sooner for fear of higher prices down the road. At the lower income levels, they kind of plow right through that because a lot of this is, what we might consider to be non-discretionary spending on goods and services. Adjusted retail food and sales, total change here. Uh, we were talking about retail sales being really strong, talk about household balance sheets. I really want to talk about, this is really more of a math issue here. We've already seen that retail sales and food service sales, are really strong. And the last data point here in this particular series, it's up 16.3%. What's really important about this is that now we're in the October readings. So, we get this data at a lag, but now we're in the late September, October readings, which actually, when you look back in 2020, we did see a big resurgence when the economy opened back up in, say, late May and during the summer. So we really saw those numbers begin to trend much higher last year in the middle of the summer. So what that means is that we have anniversaried the base effects. And what do I mean by that? Like when you are at a trough in your year one, when you get to year two, you're basing all of your year over year gains off of the trough environment. Well, we've passed that now. So these are real numbers, 16% versus this time a year ago when we were already in tremendous expansion mode from an economic standpoint. So this is a really profound statement, again, on the part of the consumer, on the part of consumer sentiment, spending, which is 2/3 of our economy. We're seeing an increased concentration of retail sales as a percent of total consumption, which, again, very powerful information here as we head into 2022. Well, we do have to talk about inflation, and this is out of a chart pack that some research I was reading from FS Investments out of Philadelphia. And I thought this was really interesting because you've got a 10-year average in the orange there, and you've got 6-month average here in the black dots. And these are the different categories of the consumer price index on a year-over-year basis. And so we know if you're looking strictly at the 6-month average, that these numbers are basically all higher year over year. I mean, you get to transportation up 18.8%. Energy prices are up 25.9%. When you get to food, we have seen food price inflation, and we're just under 4% now. But if you look at these categories that are really high, like goods inflation, really high right now. But if you look at the 10-year average, I mean, you can see where we are, in current inflationary terms relative to historical trends. And that was the power of this chart for me, was just not just looking at the raw CPI number, but looking at the components. So if you look at headline CPI, obviously over the last 10 years, we've been slightly under 2%. Core, again, slightly under 2%, but services inflation may be a little bit higher, transportation, food, energy, again, all below 2%. And it just shows you the magnitude at which, inflation has spiked here in this past 12 months. Well, now we'll kind of circle back to a couple of market-related things, and this is, kind of where the Fed's own theories diverge from the investment markets. And so we've got the Fed estimate, essentially what they call the dot plot here in the blue line, and this is just the Federal Reserve's estimate on the path of a rate hike. So, the Fed itself is only expecting one rate hike next year, and then probably another 3 rate hikes in 2023, and you can see where that trend, see where that line trends, right? So that the rate hikes are going to be back-end loaded. That we're not going to see a whole lot of activity over the next year. Now, if you turn that on its ear and say, well, what does the market think about this? And we're seeing this being priced into the market, and this is very much an expected circumstance right now. You see, the market is expecting essentially, 3 rate hikes next year, and another almost three rate hikes, in 2023. They're expecting to see a much faster normalization of interest rates, which in turning back to real yields, and I think this is a really important topic because, I mean, we're seeing negative real yields in a lot of areas. I mean, whether it be, dividend yields on the real dividend yields on the S&P 500 to real yields on fixed income, with this bout of inflation and even this acceleration of inflation, if you will, that we've seen lately, it's just exacerbated all of this. And so where we are now is we're really at a historic low point on real 10-year yields because, the 10-year yield itself, the nominal yield remains relatively low, but if you subtract this higher inflation that we've got, it makes those real yields, i.e. purchasing power, look particularly bad. And you've got real 10-year yields that, reflect a longer term horizon. They're negative 120 basis points, but if you look at the 5-year real yield, it's down almost 200 basis points. And as you might expect, looking at the Treasury inflation protection here in the TIPS market, which is Treasury inflation protected securities, you can see, the implications. And this goes back to the chart that I showed you 2 slides ago about the market's belief that we're going to have interest rate increases sooner because of this higher inflation. And that those two things are really related and tied to each other. So we've got a break-even rate on the 1 year, which is 3.6%. Again, that slides down over time because long-run inflation, should get back down to your longer-term averages. And here you can see over, 10 years, you're looking at about 2.7% implied inflation. 20 years, about 2.5, and then you get down to kind of slightly below that over 30 years. So that's the long run inflation. But, what's important here is to look at the essentially years 1 through 5 and the expectation that's being priced into the TIPS market is clearly much higher inflation than we've seen over the last 24 to 48 months. And as we take a quick peek here at the 10-year Treasury yield, again, this is a moving target. So this is data as of the 17th, and we saw a little bit of gyration there at the on the last day of the week here. But you can see that these rates have been moving in a not so linear pattern. And it's all tied to expectations on inflation, but if you believe that inflation is going to be, maybe 3 to 4% next year, and you've got a 10-year Treasury yield of 1.64, a lot of this goes back to the fact that short-term rates are basically zero, and they're expected to go up, but they're anchoring to some degree these 10-year yields. And so we've actually seen a bit of flattening in the yield curve because of these sticky rates here, because I would have expected in the wake of inflation that we've seen that you'd see 10-year yields now a lot closer to 2%, but that's just simply not the case right now. We'll talk about the energy markets here, and we've seen a bit of moderation in the energy markets, and oil is still important. We know that the demand is high right now. Supply is beginning to come back in response, but you look at the swing capacity in OPEC, which I thought was really interesting, and this came out of some data that was put together by the International Energy Association, and it looks like here that you get moderation in spare capacity. You're getting more, perhaps. Product on the market, and you're working your spare capacity down because you're just simply producing more in the face of higher demand. And so that's one thing. So when you look at that, I think that, and I've said this before over the last couple of weeks, that having more demand in the energy markets reflects a positive economic backdrop. However, when you think about having more supply come online to meet that demand, that it's going to help moderate price increases and maybe even drive energy costs down somewhat. So the oddity as we sit here and talk about all of this inflation that surrounds us, that actually at the headline level on consumer price inflation next year, oil and energy may actually have a deflationary impetus into that, maybe help to keep that lower than it otherwise would have been, just because that we're going to have more supply on the market. Now, the other thing that kind of helps maybe reinforce that opinion is looking at the right-hand side. So I thought that this is a really very interesting chart because of higher prices, we tend to see a supply response on the part of producers, especially U.S. shale producers that have a kind of a marginal cost, depending on what field you're looking at maybe $60, $65 a barrel, and we're above that now. So typically, when you see higher prices, it inspires more production. But right now, we're in an interesting dynamic because a lot of these producers, especially these wildcatters and these private, small one-off private firms, are funding themselves out of cash flow. So they're really keen to profitability, and credit for the energy markets is not as plentiful as it has been. So you see a lot of self-funding and people raising funds through non-bank environments. But the good news here, getting around to my conclusion, is that as you look in the right-hand side of that, in the light blue areas, you can see that the current environment in this COVID environment, and maybe the environment kind of heading out of COVID, is actually providing more profit. So it's addressing the issue that domestic producers have right now, is that they have to see profits before they can increase their capital spending and open up new wells, and that's happening. So this another reason why I think we have price moderation in the energy markets next year, which will again help to put a lid on headline inflation to some degree. And these charts I thought were interesting as well from Bloomberg, but you've got commodity capital spending, and so this is capital spending on the part of commodity producers, and what we're seeing here, if you look at the ratio of capex to total assets, and then commodity total returns on a 2-year rolling change basis. So, capital spending here is expected to drive a really strong, I think, price environment as we get out into towards the end of 2022. And then if you look at margins correspondingly, you can see really kind of the same thing going on right now. Margins are high, which should lead to additional capital spending, which leads to additional capacity, which helps to serve a growing demand environment. As I've been talking about, the economic data has actually been pretty good, and we were sitting around, kind of towards the end of the summer talking about how the positive surprises that we've been enjoying really since, over the last, 12 months prior to the July-August timeframe, we saw a lot of positive surprises. The economy just shot out of a cannon after having been shut down for a few months. And then those positive surprises just kind of vaporized. And then we began to see some negative data points and some mixed economic data. Well, where we sit now is that that's kind of turned back to the positive. So we've kind of settled out. We're in this, realization that we're in kind of we're normalizing economic growth environment. We're not in the kind of the post-pandemic recovery mode anymore. We're in this environment that, the economy is finding its footing for the next several years as we slowly emerge from the effects of the pandemic. And we are seeing more positive surprises in economic data right now. U.S. dollar. So, this is important as we watch the dollar, appreciate against foreign currencies. Again, the rhetoric on increasing our interest rates is increasing. So the prospect of having higher U.S. rates relative to the rest of the world is helping to strengthen the dollar. And we know that already, even, there are 10-year sovereign debt rate yields in many developed countries that are negative right now, and so the U.S. is basically the best house in kind of a troubled neighborhood when it comes to interest rates, and so that's strengthening the dollar. Again, this time series is not terribly long, but it just shows you that we weakened quite a bit, and now we've strengthened. Now, the good news here, and what I'd suggest that folks take away from this chart is I don't expect to see the dollar continue to accelerate. I do expect it to maybe go up a little bit before it goes back down. But right now, what it's helping to do is to dampen the import inflation. And as you all saw when I showed you the consumption chart, and especially the chart on the container ships, the ones sitting at anchor, and the rise in the number of container ships coming into the port of LA, that indicates demand. Well, the demand if you look at this dollar index, what it's telling you is that demand, even though prices are moving higher, that the increase in the dollar is helping to dampen those import prices a little bit. Here's the S&P 500 index operating margin. So we just exited, what I would consider to be a pretty good quarterly earnings reporting season on the part of the S&P 500, and operating margins are really high right now. Now they're beginning to eke off the top just a little bit, but as you can see in this chart, just kind of back out the noise that happened during the shutdown and just go back, 2019 to 2014. And you can see that those operating margins, I mean, we're operating at least 100 basis points or 1 full percentage point higher than any operating margin level that we've seen through most of this economic cycle, or excuse me, I should say the prior economic cycle, considering that we're technically in a new economic cycle now, but those margins are really high. And as we transition into, I guess, the marriage of economic data to S&P 500 earnings, what we have is manufacturing new orders. And even though manufacturing is a minority component of our overall economy, it's still really important. And the relationships that are built between what goes on in manufacturing and what goes on in the stock market are actually relatively strong. And you can see that here. So in the kind of the red here, you can see manufacturing orders, but these numbers are advanced 6 months. And so what we actually have seen, even though these orders are really strong, they've actually come off their highs. So there is some speculation that looking ahead 6 months, that S&P 500 earnings, because of the fact that we're off our peaks in new orders, that S&P 500 earnings may come down a little bit, but they should still be positive. And I want to emphasize that even though the chart on the left may suggest that S&P 500 earnings are going to decelerate slightly, that doesn't mean at all that they're going to be negative. Now, if you look at on the one on the right, then we've got operating income year over year, and then plotted against kind of corporate earnings indicator, and this is it's advanced 6 months, and it calls into question really when the rollover in earnings is going to take place. Excuse me. In both of these charts, it would seem to suggest that S&P 500 earnings and operating income should remain relatively positive for quite some time. On this chart, we talk a little bit about the kind of the different areas of the market and kind of what's really hot right now. And obviously, technology has been hot. And if you look at the left-hand chart, that measures the QQQ relative to the SPY, and what that means is the QQQ is an ETF for the technology companies, and it's a ratio, so it's dividing that index by the S&P 500 from a baseline. And looking at over the year, you can see that that ratio has moved considerably higher. That means that technology stocks, by and large, have done much better than the overall market. You just have to look at what's going on with NVIDIA stock over the last month to know that. And now, getting over to the right-hand side kind of puts a bow on this point here, and this is a survey from the B of A Global Fund Manager Survey. It says it's a survey of managers saying, what is the most crowded trade, meaning what's the most overvalued trade out there right now, and frankly, it is long U.S. Technology stocks. Bitcoin is a bit stretched, but these are, this is data. Looking at October, which is in the light blue, and the dark blue is November, you can see that long technology stocks were already considered, overcrowded last month, and in November it's perhaps even more so. Certainly, Bitcoin is more crowded, but those are the two areas of the market that are really hot and overstretched right now. And as we look at the U.S. markets relative to the global environment, this chart definitely tells that story, that U.S. markets are doing much better. And these are both ratios as well. So on the in the blue, you can see that is the MSCI World excluding the U.S. minus the S&P 500. And that's on the left-hand axis there, and you can see that that strength has waned as the U.S. market has accelerated. Now on the right-hand side, or excuse me, the right-hand axis, and in the amber line there, you see the S&P 500 over the MSCI World excluding the U.S. Index, and so. It's just basically the opposite, but looking at the slightly different data, but telling the same story, that the U.S. market is outperforming to a large degree international markets. Now, as we kind of get close to the end of the chart pack here, what I wanted to do was find something to help me kind of capture what people are worried most about right now. And I thought this did it. This is, again, another fund manager survey. So, this is essentially intelligent investors' feelings on what the key risk factors are in the market right now. And I think a lot of people can speculate on what, the smart money is feeling and worried about and what keeps them up at night. The interesting thing is, China is actually relatively high, but what is highlighted here is essentially a Fed mistake. Inflation is still very important. We know that. I wouldn't say it's, the most important thing. And if you go from October to November, in October, inflation was really high because I don't think anybody really understood where it was all going. The Fed rhetoric started to pick up about feeling the need, or maybe the feeling that the Fed was going to be behind the curve and where inflation was going to just overheat. Well, that was a big worry last month. Ironically, in November, it's not nearly as much. It's still very important, but not nearly as much as it was last year. What has really rocketed higher is essentially this Fed mistake, which is generally how these market runs get stopped in their tracks if you witness a policy mistake, like i.e. the Fed all of a sudden realizes, what, we're waiting too long to do this. We're going to raise rates a lot sooner. We saw that in the chart several slides ago, where the market has a definite definitely different feeling about the pace of interest rate increases than even the Fed governors, even the voting members who submit data to the dot plot feel. So that's the emerging risk right now, even more so than China, which I was actually surprised that China was as much of a risk perception as it is. But really, the key takeaway here is that rate hikes are the fear of having of not managing that well is really high right now. So we're going to end on something that I typically start off with, and this is the trailing 7-day moving average of daily new positives and daily deaths. And we have seen an uptick. It's getting colder in many parts of the country. We're seeing some emerging kind of hot zones, if you will, where we're exhibiting community spread. Obviously, we're talking about increased coronavirus cases in Europe, in many countries there, and some increased, not necessarily lockdowns, but we're seeing we're seeing curtailments on activity. So that is something we want to monitor. However, daily new deaths are trending down, and the CDC literally last night approved the booster shots for all adults, and so everybody in a regulatory environment is aligned now with that thinking here domestically that all people above the age of 18 should get a booster shot. And so we'll see more inoculations amongst call it the 65% of the country that is vaccinated. Many of those people will go back and get booster shots. So, the rise that we see in daily new positives will largely be tied to the unvaccinated as we trend into the colder months. That's all we have for this week. Hope you've enjoyed the broadcast. On behalf of the entire team at BKA Wealth, hope you have a wonderful week, safe week, a happy Thanksgiving, and we will be back the following week. Take care. Goodbye.